Good afternoon. Peter Klein, Chief Investment Officer, ALINE Wealth, joining you today on the 24th of November, after market close, the day before Thanksgiving. And indeed, we have much to be thankful for. It looks like we are getting somewhat back to normal, and certainly the markets have been, at least up to late, very helpful and prosperous for us. So I'd like to walk you through one of our conditions videos, going through those market and economic conditions. Allow me to share my screen, and we'll walk through some slides that I think are intriguing and interesting. Here we go. So let's look at the agenda. Here it is. And I've called this off the charts. And I say that tongue in cheek, essentially suggesting, and we'll have some concrete evidence to back our thesis, that indeed we are in a setup, both economically and market-wise, that suggest that things are really just a bit off the charts. And maybe that's good. Everyone seems to be dancing. No one's worried, or very few are worried about the music stopping. Allow me to tell you, it will stop. It always does. And our job here at ALINE Wealth is to provide our clients with a big, comfy couch so that they always have a seat. And when the music stops, they can relax and be comforted by the fact that their portfolio has been proactively managed to win the race, slow and steady, as they say. So we'll talk about frothy sentiment. We'll talk about the stretched valuations we're seeing out there. Economic slowdown plus inflation, no go. That's not a good thing, and we'll talk about that. And of course, we can't obviously just sort of sit on our hands. We've got to do some allocating of investment. Of course, we do that every day, all day long, and we're finding some intriguing investments along the whole spectrum of what we've talked about last time, the 4 I's and a V, right? We'd spoken about international, inflation, infrastructure, innovation, and value. So we'll go back to that a little bit today as well. Okay, I'll get you guys home in time for your turkey, I promise. Okay, sentiment. Fear and Greed Index, it comes to us by CNN. As you can see, as of late, we are, extreme greed. Folks, you don't want to allocate a lot of capital towards risk when everyone else is doing that, okay? You want to do it when it's extreme fear. Why? That's when the prices are the best, like down here, So we'll see. We'll see how this pans out, but obviously we're concerned. Call option has become the new sort of vehicle du jour for speculators. I mean, it always has been, but now we are seeing young investors sort of use options, almost like a new penny stock, if you will. And you can see here the call volume is essentially off the charts, and that suggests additional frothy conditions. And this piece by our friends over at GMO, great group out of Boston, and classic signs of speculation. More than half of the United States growth stocks that have negative earnings. It means they're not earning money. Negative earnings means you're losing money. Yet growth stocks have dramatically outperformed for the last few years. Folks, that's a disconnect. I call it hubris. It doesn't make much sense. You cannot have companies doing great when they don't have earnings. I mean, it's sort of like, you need that kind of, you need the mother's milk of increasing stock prices. Is not momentum, okay? It is earnings. That's what makes the difference. What we have here is a speculative frothiness that is dangerous. And we see these spots that GMOs indicated here on this chart. Okay, another sign of the potential frothiness out there are the debt that investors are taking against their portfolio, margin debt, up 38% this year. In the last 2 months, it has surpassed $900 billion for the first time ever. It's worrisome because a little margin debt may not have killed anybody, right? If you have, 10, 12, 15% of your portfolio, maybe you're doing something with it. Maybe you're buying a a property or what have you. I can understand that, especially at these low interest rates. My fear is when it becomes untenable, when it becomes something where it's 50, 40, 60% of a portfolio, that's when a big problem can happen, because ideally, I mean, eventually, I should say, inevitably, the market conditions will switch, the asset values will come down, but that debt doesn't go away, and now you're upside down, and now you're forced to sell at lowest prices. That's not good. When is there too much debt? This is a slide that shows how much debt's in the system. We've spoken about this time and time again. It is an issue that is something right on our radar, front and center. It's a concern. More and more, we have $85 trillion of debt in the United States. 85 trillion. You see I was in Washington a few weeks ago watching my son play in some fall lacrosse, and you see these signs all over the city of Washington, financed by the Peterson Foundation, and it has like a ticker, like a sort of a debt clock, and it shows how much debt the United States, total debt, right? 85 trillion. That's a lot of cake. Okay, valuations. This is price to sales. So that is, in my view, ground zero, if you will, of the frothy overvaluations we're seeing. I did an analysis on the QQQ, or the NASDAQ index, and I noticed more than half the portfolio is trading at more than 10x sales. I remind you of this 10x sales metric because back in the aftermath of the .com, we saw a major issue with shares of Cisco. Now, we may remember Cisco was the darling of the then market move, and the big stock for the period of the .com. And at the time, the shares were trading at 10 times sales. And the CEO at the time afterwards was talking about that, and said, what were you guys thinking? You could actually Google that. What were you thinking, Scott McNally? And he talks about what the analyst community was thinking about when you're looking at 10x sales. You can't do that. It doesn't make sense. And yet we're seeing so many companies trading today at these inflated values and inflated multiples. It is worrisome. Here is the two, again, back to the price to sales over 10x. Here's that number. And then it's showing the cheapest quintile. So we're breaking this out in quintiles, and you can see how the most expensive multiple quintile is here, and the least is here. Tale of two markets. I will go out on a limb to say that this is likely to reverse somewhat. This is the CAPE, Professor Schiller from Yale, cyclically adjusted earnings over time versus PEs, second highest ever right now, 37.98. Remember that number, we'll come back to it shortly. This is concerning, of course, as well. And listen, folks, valuations can stay inflated for a long time, and frankly, they have for a while. Notwithstanding the March, April 2020 COVID fall, but for the most part, since the lowering of interest rates and we that we've seen in the last 10 years, markets have been trading at higher multiples than typical. But that doesn't mean that it's a condition that's going to last forever, right? I remind you of 1996. Then Chairman Greenspan, one of the most sort of erudite economists of our generation, of our time ever, came out in December of 96 and said, irrational exuberance. What are you guys doing with this .com thing? It's getting out of hand. It took the market 3 years for them to wake up. So for those for 97, 98, 99, those that stuck with it and ignored Professor Greenspan, Dr. Greenspan, appreciated and did well. And until we saw the market fall years later in March of 2000. Back to Cisco, it has never gotten back. So even today, and I link Cisco, it's never gotten back to where it was back then. Interesting, right? So yet its earnings have grown, everything has grown nicely. but the multiple was too high. And that's the problem with multiples. So that's an important understanding issue. Very similar to what happened with the Japanese Nikkei index in 1989. Everything was Japan. That was the story back then. And that index topped out of 40,000. It's 28,000 today. 35 years later, 40 years later. So this is what happens with euphoria and multiples and the madness of crowds. This is what happens. And our job as stewards and fiduciaries is to cut through that hubris and get down to the mathematical tactics. Okay. Now this is important. Remember I told you, remember that price to sales, that CAPE rather, of 38? So we're in this zone, over 30. So this is Schiller's research, and this is saying Nobel Prize winner, by the way, Yale professor, valuations matter. So this is the 3-year return for 3 years. It's 1900, long data set, on the CAPE, when the CAPE ratio is these levels. So when the CAPE is greater than 30, as it is today, the average 3-year return is -4. Average 3-year return is -4. When it's less than 10, it's 39. Moreover, the average 3-year drawdown, top to bottom, when the CAPE is above 30, negative, that's not 2.3, that's 23. Okay, this is why I'm concerned. This is why we're concerned. And this is why we're coming to our clients and saying, let's talk about the portfolio. Let's immunize it. Let's look to make sure that you're okay and your financial plan's okay and it's going to work out fine. That's being proactive. That's being a steward. When we talk to GMO, they talk about this idea of when will, the deflation start. I'm thinking about inflating the Thanksgiving Day balloons on the West Side today. But no, deflation, right? When the bubble begins to pop, right? When does that happen? Usually that happens at 2 standard deviations, and we're seeing that now. We're at almost 3. So Jeremy Grantham and the folks at GMO are concerned. They have been, though. So this is not something new. So you could sort of say, all right, they've been, quote unquote, wrong or early. I prefer early. We'll see. But as custodians, as stewards, we've got to be mindful of this data. It's important data. Economic conditions, here we have signs of global stress emerging. The auto sales down precipitously, German confidence down. That might be COVID related. China, of course, has been hit hard as well. Another data point that's interesting that I came across recently, the NFIB, which is the National Federation of Independent Businesses, the Small Business Index, came out last week and said they found the outlook for the United States economy the worst it's ever been in its 50-year history. That's a small business index, the Federation of Small Businesses saying that this economy's punk. Basically, they're saying there are issues out there. Yet Wall Street has not woken up to that, because Wall Street will always work as a pendulum, extreme, extreme. So we need to be mindful of that. This is a disconnect, right? Here's the market, here's earnings. You see how tightly correlated they typically are? Woof. That gives one pause. Correlation between inflation and multiples, right? They said what the most important thing to a multiple, price to earnings multiple, is not the GDP, it's essentially return on equity and inflation. And with the inflation numbers increasing as of late, the suggestion is that we're going to see lower PEs, but we haven't. And so this is a great disconnect right here between what is currently going on and what is expected. This is predicted, this is current. So, I mean, this is concerning. Okay, well, you know what? We can't sit on our hands, right? We've got to put capital to work mindfully and proactively. And we do that all day long. So we're looking for ideas. And I said before, the 4 I's in a V. You can watch our videos, go to our site, check it out at alignwealth.com. So we're looking at value, and we're seeing here that there's a clearly an opportunity relative to growth, that value has been picking up, and indeed it has since the vaccine introduction a year ago. So we're seeing that it's a continuation. There's a long runway here. When value begins to outperform growth, it's typically a long runway of opportunity. We think that's going to maintain for some time. So we like value. And here again, you're seeing the multiple differences between the Russell 1000 growth in red up here and value down here, opportunity. Now, we do prefer international here. We're overweighting international because we see a lot of opportunities here. We think European stocks are breaking out, and the COVID recent COVID outbreaks and such notwithstanding, we think there are some opportunities there from a valuation perspective, an economic perspective, and you can see here technically the index looks like it's about to break out, so that's a positive. What's cheap? Well, UK is cheap, and so is a lot of emerging markets as well. This is the 10-year CAPE valuation tour. Look what's expensive. You have a mixed bag here, but down here, I think you can see some opportunities. Case in point, more data on the discount from a PE perspective to a price to book perspective of the UK. So UK, interesting. We think there's some opportunities there. The commodities is also, we talked about inflation. It's one of our eyes. So commodities is another spot that we feel as being opportunistic going forward, and one that we could see some strong opportunities for a while to come, because it has been down for so long. And it's called a regression to the mean. That's a number one tenet in finance, right? Is that when something goes way above its mean, it comes back down to its mean, vice versa. Well, we're seeing commodities in a downward motion for 15 years, and we think that that's changing. So this is the deflationary, early aughts and early teens, and we've seen that changing. We see that changing here. We think that we're going to see more upside in commodities across the board. Thank you. Thank you for your time and attention and the vote of confidence you've given our team here at Align Wealth. We're here to wish you a happy, healthy holiday season. Happy Thanksgiving. We have much to be thankful for. Let's remember that. Thanks again, folks.